Right now, as the market is live, Pinterest stock is trading at $27.14, which is a jump of $1.39, putting it up 5.40% for the session. And that 5.4% green number is exactly the kind of figure that can be dangerously misleading if taken at face value. This is not a rally, it's a tremor. This is the classic dead cat bounce that so many traders on the Robinhood app look for, a small, reflexive jump after an absolutely catastrophic event. The immediate expectation when you see up 5% is that the company is building on positive momentum. The reality for Pinterest is that it's trying to find a floor after being vaporized yesterday, closing down nearly 22% in one of the most brutal post-earnings reactions we've seen this quarter. So today's move isn't strength. It's a fraction of a recovery from a massive loss of confidence. The stock was trading comfortably above $32 just 2 days ago. Today, it's fighting to stay above $27. This is the critical context that separates a hopeful headline from the harsh reality of the market, and it's why just looking at a simple chart on an investing site's dashboard can set you up for failure. Let's establish the common ground, the narrative that was building up until 4 p.m. on Tuesday. The general belief was that Pinterest was the comeback kid. Under new leadership, it was finally cracking the code, moving from a simple digital mood board to a powerful commerce platform. The talk was all about its record-high user base, its smart integrations with platforms like Shopify, and its unique position as a positive corner of the internet, far from the toxic debates on other platforms. Investors, particularly those in Fidelity mutual funds or using SoFi robo-advisor services, saw it as a growth stock that was finally maturing. The expectation was that this week's third-quarter earnings would be the final validation, the report that proved the monetization strategy was working and that average revenue per user was catching up to the impressive user growth. That was the story. Then reality hit. The Q3 report was a perfect example of a good, but not good enough, disaster. When you're a growth stock trading at a premium multiple, good doesn't cut it. You need to be perfect, and Pinterest was far from it. Let's break down the numbers that caused yesterday's 22% collapse. The headline that everyone celebrated was monthly active users, or MAUs. The company hit an all-time high of 600 million global users, a 12% increase from the year before. This was fantastic. It proved the platform is still growing and engaging people. Revenue was also strong, coming in at $1.049 billion, a 17% jump year over year. That's not NVIDIA stock level growth, but it's very solid. So, more users and more revenue. What on earth went wrong? Two critical things. First, earnings per share. The market was looking for 43 cents. Pinterest delivered 38 cents, a 5-cent miss. In this market, for a tech darling, that's not a stumble, it's a fall off a cliff. It immediately signals that costs are rising faster than profits or that the revenue per user isn't accelerating as hoped. But the real killing blow was the guidance. Wall Street lives and dies by the future. The company projected fourth-quarter revenue, the critical holiday shopping season, to be between $1.313 billion and $1.338 billion. This implies 14 to 16% growth. The market heard that and hit the sell button so hard it nearly broke. That range was softer than analysts had modeled. It suggested that all this user growth and all these new e-commerce tools were not translating into the explosive holiday ad spend bonanza everyone had priced in. This is the core tension. The expectation was that 600 million users would lead to a massive acceleration in high-profit ad revenue. The reality was a 17% revenue gain that resulted in an earnings miss and a forecast that signals, at best, moderate growth. That discrepancy is what cost shareholders 22% of their investment in a single day. The volume yesterday was staggering, multiples of its daily average. This wasn't just retail panic. This was Fidelity Wealth Management and other big funds reevaluating their positions in real time. So that brings us back to today's 5% bounce. This is bargain hunting, plain and simple. It's traders using interactive brokers' trading platforms to scalp a few points, betting that the sell-off was overdone. It's also where the analyst community is providing some cover. Despite the miss, the reaction from firms like Goldman Sachs, RBC, and BMO was not to issue sell ratings. Instead, they maintained their buy ratings but slashed their price targets. They essentially said, "We still like the long-term story, but we were clearly wrong about the short-term profits." Goldman, for instance, cut its target from $43 down to $36. RBC dropped its target to $38. These new targets are still significantly higher than the $27 where the stock is trading today, which gives some ammunition to the bulls who are doing their self-investing and see this as a deep value opportunity. They are betting that the market overreacted to a minor EPS miss and soft guidance. This is the battle line. Is Pinterest a broken growth story, or is it a high-growth company on sale? When we look at the broader business, the company is doing things that, on paper, should be working. It's not just a place to find recipes. It's aggressively pushing to be the place you buy the ingredients. The Shopify integration is meant to make every pin a potential storefront, closing the gap from inspiration to purchase. This is the holy grail of social commerce that platforms like Instagram have been chasing for years. Pinterest has a user base that is explicitly on the platform to plan purchases for their homes, their weddings, and their wardrobes. The intent is there. The failure, it seems, is in the speed of monetization. The international user base is huge and growing fast, but the average revenue per user in those regions is a tiny fraction of what it is in North America. The company is succeeding at getting global users, but it's failing at getting their wallet. This is a critical point for anyone using Fidelity or SoFi Invest to build a long-term portfolio. The thesis rests on that international ARPU gap closing. Yesterday's report suggested it's not closing fast enough. Let's put this in the context of the wider market. We've seen stocks like Tesla and Apple gyrate on macroeconomic news, on interest rate fears, on supply chain whispers. Pinterest's drop was entirely its own. It was a self-inflicted wound. This makes it a very different kind of online investment. You aren't betting on the Fed. You're betting on CEO Bill Reddy's ability to execute this commerce strategy. You're betting that the new AI-driven tools for advertisers will actually drive higher ad prices. The bull case is that the company is investing heavily right now in AI, in shoppability, and in user experience, and those costs are what caused the EPS miss. They argue that this is the right move for the long term, and the market is being myopically focused on a single quarter's profits. The bear case is that they are spending all this on features that users don't actually want, and that people will always browse on Pinterest but buy on Amazon. The platform could be stuck in a permanent low monetization friend zone with its 600 million users. For those of you managing your own portfolios, perhaps through an individual brokerage account or looking for investment help, this is a classic falling knife scenario. Trying to catch it is risky. The stock has decisively broken below its key 50-day and 200-day moving averages. Those technical levels are now resistance overhead. It will take a lot of buying pressure, far more than this 5% bounce, to repair the technical damage on the chart. Many automated systems like Schwab Intelligent Portfolios or other intelligent portfolio services will likely be algorithmically reducing their exposure due to this spike in volatility and the break of long-term trend lines. This creates more selling pressure, which is why seeing a green day today is nice, but it's far from a sign that the pain is over. We need to see the stock stabilize and build a new base, likely in the mid to high $20, before any real sustainable uptrend can even be considered. This is a stock that attracts a lot of online investment interest from people who use the platform. It's a buy what you know story. But knowing the app is not the same as knowing the business. The app is great. The business, as of this week, is in the penalty box. I want to know what all of you are thinking. Let me know in the comments. Are you using this 22% drop as a buying opportunity, or are you cutting your losses and staying far away from pins? Looking forward, the path for Pinterest is now incredibly difficult. It has lost the market's trust. The expectation of a smooth growth story is gone. The reality is that management will have to fight for every dollar of ad revenue and prove quarter after quarter that their e-commerce strategy is more than just a buzzword. The next earnings report will be one of the most important in the company's history. They must meet or beat that soft guidance they just gave for Q4. If they miss again, the stock could easily see another 20% drop. The opportunity is clear. If they can monetize 600 million users even a little bit better, the upside is enormous. The risk is that